Scene script. Have you ever wondered how the wealthy keep getting wealthier? It's not just about earning big or inheriting a fortune. It's about harnessing the power of investments. You see, wealth doesn't just grow in a savings account. It flourishes when it's invested wisely. Imagine your money as seeds. If you keep those seeds in a jar, they won't do much. But if you plant them, give them sunlight, water, and time, they can grow into a bountiful harvest. That's what investing does. It sows your money into opportunities that can yield significant returns. In this video, we'll demystify the world of investments. We're breaking down complex concepts and strategies into easy-to-follow steps. Whether you're a beginner or an experienced investor looking to refine your approach, there's something here for you. Remember, investing isn't a luxury reserved for the rich and famous. It's a necessity for anyone seeking financial growth. Investing is not a luxury, it's a necessity for financial growth. Before diving into strategies, grasp the basics of investing. Investing at its core is about using your money to potentially generate more money. But this enticing prospect comes with a degree of risk. The first basic principle of investing is understanding the relationship between risk and return. Higher potential returns often come with higher risks. That's the balance every investor must grapple with. Now, imagine you're placing bets on a horse race. You could put all your money on one horse, hoping it will win. But if it doesn't, you lose everything. That's where the second basic principle of investing comes in: diversification. It's like spreading your bets across several horses. If one doesn't perform well, the others might. Diversification helps mitigate risk by spreading your investments across different types of assets, such as stocks, bonds, and real estate. This way, even if one sector struggles, others might thrive, balancing your overall portfolio. The third basic principle is the importance of time in investing. Investing isn't a sprint. It's more like a marathon. The longer you stay invested, the more opportunity your money has to grow. This is thanks to a magical thing called compound interest. It's the process where the interest or dividends you earn on your investments start earning their own interest. Over time, this can lead to exponential growth. And lastly, it is crucial to remember that investing is not a get-rich-quick scheme. It requires patience, discipline, and the ability to stay the course during market fluctuations. It's about building wealth over time, not overnight. So there you have it. These are the basic principles of investing: understanding risk and return, diversifying your investments, recognizing the importance of time, and exercising patience. Becoming familiar with these principles is like building a solid foundation for your investment journey. It's not about predicting the market's every move, but understanding how it works and making informed decisions. With these basics, you're ready to move on to the strategies. Scene script. Ever heard the saying, "Don't put all your eggs in one basket"? Well, this old adage holds a kernel of wisdom that is as true in the world of finance as it is in everyday life. This wisdom is encapsulated in the investment strategy known as diversification. In essence, diversification means spreading your investments across a variety of asset classes, rather than focusing all your financial resources into a single investment. Imagine you're at a buffet. There's a great assortment of dishes available, some you know you like, some you've never tried before, and some that might be a bit risky, but could turn out to be the most delicious of all. Now, would you fill your plate with just one dish? Or would you take a little bit of everything? Most people would choose the latter. Why? Because it gives you the opportunity to enjoy a wider range of flavors and reduces the risk of ending up with a plate full of something you don't like. The same principle applies to investment. By spreading your investments across different asset classes, like stocks, bonds, and real estate, you can reduce the risk associated with the potential failure of any single investment. For instance, if you invest solely in the stock market and it takes a downturn, your portfolio could suffer significantly. But if you've also invested in bonds and real estate, these investments may help cushion the blow, as they could perform well even when the stock market is struggling. Moreover, diversification can also increase potential returns. Different asset classes can perform well at different times. So by having a diversified portfolio, you're more likely to have some investments that are doing well, even when others aren't. This can help smooth out your returns over time. In conclusion, diversification is about balance. It's about not putting all your faith in one place, but spreading it out, taking calculated risks, and increasing your chances of success. It's about building a portfolio that can withstand the ups and downs of the market and ultimately provide you with a more secure financial future. Diversification, a simple yet powerful strategy for risk management. What if there was a way to reduce the impact of market volatility on your investments? Well, there is, and it's called dollar cost averaging, or DCA for short. To understand DCA, imagine you're a steady, unflappable investor who doesn't let market highs and lows dictate your decisions. Instead, you invest a fixed amount of money at regular intervals, regardless of whether the market is up or down. This could be weekly, monthly, quarterly. You choose. The key is that you stick to your schedule, come rain or shine. So why would you want to do this? Well, when the market is down and prices are low, your fixed investment buys more shares. When the market is up and prices are high, the same investment buys fewer shares. Over time, this strategy can potentially lower the average cost per share of your investment. To put it in simpler terms, let's consider an analogy. Imagine you're buying apples from a local market. The price of apples fluctuates day by day. Some days apples are expensive, and on others they're cheap. By buying a fixed dollar amount of apples every week, you end up buying more apples when they're cheap and fewer when they're expensive. Over time, you've managed to lower the average cost of the apples you've bought. That's DCA at work. Now, it's important to remember that DCA doesn't guarantee a profit or protect against a loss in declining markets. You should always consider your ability to continue investing during low price levels. However, DCA does offer a disciplined approach to investing. It can help take the emotion out of your investment decisions and can potentially smooth out the impact of market volatility. Instead of trying to time the market, you're committing to a long-term strategy. Dollar cost averaging, a strategy that turns market volatility into your ally. So despite the rollercoaster ride of market highs and lows, remember with DCA, you're in it for the long haul. And over time, that can make all the difference. Ever wondered why patience is a virtue is a common saying among successful investors? It's because a strategy that has proven its mettle time and again in the world of investing is long-term investing. This approach is not about making a quick buck, but rather about building substantial wealth over time. At the heart of long-term investing is the concept of compounding. You can think of compounding as the snowball effect. When you roll a small snowball down a hill, it starts to accumulate more snow and grows larger as it descends. Similarly, when you invest money, you earn returns on your initial investment. But here's where the magic happens. These returns can then be reinvested, and they too start earning returns. Over time, your investment snowballs, growing larger and larger. Let's illustrate this with an example. Imagine you invest £1,000 in a quality asset that yields an annual return of 7%. After 1 year, your investment grows to £1,070. If you reinvest those £70 in the second year, you'll earn returns not only on your initial £1,000 but also on the reinvested £70. Over a long period, this process repeats and amplifies, leading to exponential growth of your investment. However, it's important to note that long-term investing is not a get-rich-quick scheme. It's a marathon, not a sprint. It requires patience to resist the temptation of short-term gains and discipline to stick to your investment plan even during market downturns. Remember, it's time in the market, not timing the market, that builds wealth. Investing in quality assets is also key to this strategy. These are assets that can withstand market fluctuations and deliver steady returns over the long haul. So it's crucial to do thorough research and make informed investment decisions. In conclusion, long-term investing is a strategy that leverages the power of compounding to build substantial wealth. It's a testament to the age-old wisdom that good things come to those who wait, or in this case, to those who invest with patience and discipline. Long-term investing, a testament to the power of patience and compounding. Investing is a journey, not a destination. And just as every journey needs a roadmap, understanding investment basics acts as your compass in the financial world. We've navigated through the power of investing, highlighting how it can propel you to financial growth and stability. 3 key strategies have been our waypoints: diversification, dollar cost averaging, and long-term investing. Diversification, spreading your investments across different asset classes, minimizes risk and maximizes returns. Dollar cost averaging, a method of investing fixed amounts at regular intervals, mitigates the impact of market volatility. And lastly, long-term investing, the practice of holding onto your investments for extended periods, harnesses the power of compounding to build enduring wealth. Every great investor was once a beginner. The strategies we've discussed today aren't just for the Wall Street wizards, they're for anyone willing to take that first step. Remember, every successful investor started with a first step. Your journey towards financial growth starts now.